What do you anticipate the stock price of Tesla to be following the 3-for-1 split? Given its sharp swings, it is becoming increasingly difficult to forecast the stock price of an electric vehicle firm these days. Watch and listen for forecasts regarding the price of Tesla stock following the split. Investors have been extremely concerned about Tesla's stock performance in the market in recent months. The present price of Tesla stock at $891.45 is a welcome change from the $600 to $700 area where the EV company stocks had been trading in previous months. You're going to see a frightening forecast for the price of Tesla stock following the 3-for-1 split today. Recently, there have been significant swings in the market for many equities, including those of Tesla and other large companies. These businesses are still doing well in spite of the price decline, and they regard this as a natural evolution resulting from the many unanticipated events that have happened throughout the world and have impacted the global economy and stock market. Tesla announced a proposed 3-for-1 stock split ratio earlier this year. A stock split, what is it? As to Forbes, a stock split occurs when the board of directors of a firm distributes more shares of its stock to its existing shareholders without reducing the value of their equities. A stock split reduces the value of each share individually while increasing the number of shares in circulation. A cosmetic split of the shares may indicate that smaller investors believe they may purchase the stock, despite the fact that their numbers pale in comparison to those of major institutions. Splitting. Stocks doesn't alter a company's worth. Investors in a corporation that splits its stock into 2 shares at a price of $50 each, for instance, would end up with 2 shares worth $100 each. Their previous single share was worth the same as the value of their 2 new shares. But according to Reuters, which cited research from Bank of America, businesses that divide their stocks frequently do better than the market. This can be the result of investors purchasing stock in a company following a split on the belief that the shares are now more reasonably priced. Stock splits are a common strategy used by companies whose stocks have reached high levels to increase individual investor access to the assets. This year, Elon Musk's $44 billion acquisition attempt for Twitter and the COVID-19 related stoppage in Shanghai that halted production at a Tesla factory have caused a sharp decline in Tesla shares. Tesla's stock has been under pressure since Musk made this contentious declaration and used his shares in the EV company to finance the purchase of social media. Tesla has provided more details about its intentions for the August 4, 2022 annual stockholders meeting in a 14F filing with the SEC. Tesla announced that it intends to split its common stock in a 3-for-1 ratio, which will treble the number of shares available and split the price by 1/3 on the day the stock split occurs, in addition to the many agenda items specified in the 14F filing. This action only makes more common shares of a publicly traded company available while lowering the price to make shares more accessible for investors. It has no effect on the firm's valuation. We want to guarantee that every employee has access to the same benefits regardless of when they join, according to Tesla's proxy filing with the Securities and Exchange Commission. We think the stock split would help reset the market price of our common stock so that our employees will have more flexibility in managing their equity, all of which, in our view, may help maximize stockholder value. We provide every employee with the opportunity to receive equity, unlike other manufacturing, it continued. Stock splits frequently have an impact on stock performance because fractional shares make the stock appear more affordable or easier to purchase. The financial stake of current Tesla stockholders won't change, despite the split perhaps being advantageous for prospective investors. The sole distinction is that, should stockholders approve the proposal, they will own 3 times as many shares. A major justification for this kind of stock split is to have a favorable psychological effect on investors. A share price increase may cause it to appear unaffordable. Even if the market capitalization of the company remains the same, a less expensive stock may be viewed as having lower value. With what is thought to be a more accessible stock price, a stock split may make shares more affordable. It may appeal to investors who would not have chosen that particular stock otherwise. A draw like that might increase demand and eventually raise the price of the stock. Amidst multiple challenges that have impacted Tesla's production, Barclays, a British multinational universal bank that operates as 2 divisions, Barclays UK and Barclays International, is increasing its price objective on the company's Tesla shares. In addition to increasing its price objective on the top EV firm by 14%, Barclays is well known for being a significant worldwide provider of financial services, including wealth management, corporate and investment banking, credit cards, and retail banking. This means that Q2 production will probably be about 256,000 as it was for the 250,000 deliveries that were reported in the most recent Q2 financial report. Even though Elon Musk, the CEO of Tesla, has called for 300,000 deliveries, only 250,000 have been made, which is thought to be the biggest drop in Tesla's history. Though some may find it acceptable, the company's delayed launch was partly driven by the previously mentioned China shutdown, which also had an impact on the Shanghai facility and the supply chain. However, UBS also increased its price objective, resulting in a sizable order backlog and significant margin momentum. With operations in more than 50 nations, UBS Group AG is a global investment bank and provider of financial services. They continue to project a 50% annual increase, with a $1,100 price objective. They are more likely to take a year-long view, as opposed to a quarter-by-quarter one. Since batteries are the main obstacle for the EV industry, they also anticipate that Tesla's vertical integration, semiconductor software, and battery will lead to superior growth and profitability. Furthermore, they think that because Tesla owns its own factories and manufacturing facilities for battery construction, it is in a unique position to deliver on its promise of driving higher margins with its batteries. According to UBS's bull case scenario, Tesla's gross margins might increase from 30%, where they presently stand without tax credits, to 34.7%, which is a highly optimistic estimate. With an increased buy rating, UBS now believes there is over 50% further upside for the electric car company shares. When the stock split, would you purchase Tesla stock? Please share your thoughts with us by using the comment area below. The company will have seen 2 stock splits in less than 2 years if this year's proposed 3-for-1 split is approved. It is worth noting that Tesla announced a 5-for-1 stock split on August 11th, 2020, and that the split became effective on August 31st of the same year. Prior to the split, shares were valued at $2,213.40 each, but following the split, shares were trading at $442.68. At this point, Tesla's stock was trading for about $1,300 per share. However, the announcement of the stock split caused it to spike to a record high of $2,000 per share. As a result of the split, the price per share was reset to about $460, with a valuation of approximately $430 billion. According to Robert Johnson, a finance professor at Creighton University's Heider College of Business, splits are generally welcomed by investors as they indicate that the company they are investing in is doing well. If an investor was drawn to Amazon prior to the split, now would be a good moment to invest because the shares are more accessible, according to Stivers. But you ought to only do it if it's a component of a portfolio that is well diversified. Some claim that even though it may be alluring to purchase an expensive stock when it becomes much more affordable to do so, keen buyers should make sure the stock is in line with their overall financial objectives. However, unless it has long been a component of your portfolio objectives, one shouldn't jump all in just to possess Tesla stock, for example. It is no secret that the global expansion of the COVID-19 pandemic caused numerous challenges for Tesla and other manufacturers in the previous few years, including supply chain problems. Unquestionably, Tesla continues to lead the EV market. Many investors are of the opinion that the EV company has a great deal of potential and can flourish in the future far more than most people would have predicted, even those with years of expertise in the financial sector. But considering the volatility of the stock market, it is no secret that there is no such thing as certainty in this area. However, the options are virtually limitless. It is noteworthy, however, that before making a significant decision, careful research on the stocks is necessary to reduce risks. Check out our other videos on our channel for more information about Tesla stocks.